Welcome to 3 insider secrets to thriving in rental property investing in 2024. And honestly, always. Most rental properties are depreciated over a standard depreciation schedule, which is 27 and a half years. However, you can use a very wonderful and unique tool called cost segregation. Now, this isn't, I don't want to call it, it's not easy. It has some levels to it, and it does cost some money, and there's no expectation as to how much it's actually going to work. But it is a great tool if you're in the a building stage, okay, of building your rental property portfolio and needing more cash to do it. Cost segregation can help you get a large sum of the appreciation on the front end, which will be taken against your taxable income, which means you pay less taxes, which means you have more money in your pocket, which means you can buy more rental property if you're in acquisition phase. Depending on what market timing you're in, if you're in a retractory or even a flat market, sometimes you can use a tool called a wrap loan. It kind of allows you to do seller financing, be the seller financier without doing seller financing. It could go both ways. So if you're the landlord and you've got a rental property that's leveraged up with a mortgage, and let's say that mortgage is 4%, which investors could get those rates right after COVID. And you want to sell your rental property, and the current market interest rate for investors is 7%, which is exactly the story we're in right now. If you, this doesn't always work, I'm going to be honest, but I have been a part of one personally in one of my apartments I bought, so I know it works. But you can wrap your loan around someone else's new loan, and essentially you finance it for them, meaning you're going to take their mortgage payment that they pay you and you're going to pay your lender. And there's going to be a spread in that because they're going to pay you 7% interest and you're going to owe your lender 4% interest. And likely you're selling it to them for a higher price, probably, but not always. Sometimes not. But nonetheless, there's some kind of spread in there for you that creates a cash flow. Okay. So you're selling the property, but there's still a lien attached to it. This is a lot longer than a short video to explain it, but that is one way to be successful using a wrap load. It's a very creative tool, very misunderstood, and a little bit complicated, but totally possible for you as a rental property investor. And number 3, the move up strategy. The move up strategy is for those of you that have more time and less money. So this allows you to get into your first property as an owner occupied. That means less money down, a lower interest rate as an owner occupied person, mortgage holder. And what you're going to do is you're going to stay in that property for a period of time. That period of time varies. It's market dependent because what we got to do is get that private mortgage insurance off, most likely, because that's going to truncate and eat all of your cash flow. And you need a little bit of time to build that equity in order to do that. If you just let it fall off naturally on your amortization schedule of your mortgage, it's about 7 years. But if the market's rising quicker, you can get it off quicker and the lender can reappraise it and you can knock it off sooner. So this is a strategy dependent on market, but it is a strategy that pretty much every elephant in what type of rental property investor am I started as, including me. It is a very common strategy for those that don't have the money, but have the risk tolerance and the effort and are willing to go for it. So remember, the key to getting ahead is getting started. You only need a handful of rental properties to become a millionaire in a couple of decades and change the entire financial trajectory of your whole financial downline generationally for whoever knows how many generations to come. Hope this helps. And from Rocky and I, see you later.